Hello everyone, welcome back to the Daily Gold YouTube channel. This video is being recorded on the afternoon of Friday, November 1st, 2024. And with me, as always, to do our monthly recap at the end of every month, here to recap the end of October and tell us what it means moving forward for the gold and silver markets. He is Professor Vince Lanci. He is a professor, an adjunct professor of
Agile. Let's
finance.
not let. There are real professors out there. There are people that do the work. They
Okay,
do.
you are a professor, an
I
adjunct
know. No, I'm a
professor.
professor. I'm a professor. I definitely profess. I'm a
You're a
professor.
professor of finance and corporate finance, I believe, at
Professor of
UConn.
futures and options. By the way,
Futures and
I
options.
actually
That's
talk about
very
technical
impressive.
analysis. Not like you. Matter of fact, maybe I could have you on for a guest lecture when we do charts. We could do
Oh,
that.
well, I love to talk and I love other people hearing me talk, so I'm down for that
Exactly.
whenever. Vince also writes the Gold Fix on Substack. You guys should subscribe to that. And he's also with Echo Bay Futures. So, Professor,
Yes.
um, in our pre-show prep, we talked about a few things that we're going to talk about. I mentioned the 2 or 3 charts that I find most interesting right now. Where would you like to start?
Oh, that's a sneaky play. Let's start with the easy stuff. What I mean is actually let's start with the stuff we don't really have much to talk about because I want to ask you about the CPI stuff and the 60/40 portfolio because I know you put a couple charts out about that. The month end, like, uh, was this a good month compared to say other months? That's I don't think it. I don't. I what I did say before was this certainly isn't a bad month. Okay. And we have been spoiled. Gold closes better than silver. And you'll give us the details on that. But I kind of feel like, and this is why like I'm kind of copping out. My month-end analysis, I feel like I want it to end the day after the election because the week it's like is it noise? Yeah, it will be noise, but it's where that week closes that matters to me. So I feel like this is the pause before the event. So I feel like this is an unnatural. We're in an unnatural spot. So that's it. That's all I can say. And silver, disappointing for me because I was like, it's going to go to 35, it's going to go to 35, and it didn't. And so 34.90 or something like
Wait,
that.
it did go
And
to 35.
so I'm right. So I'm a
I
genius.
mean, yeah, well, I haven't looked at the exact print, but I think it did. I mean, more or less, if it gets up to 34.90 it's close enough.
Close enough. So I'll declare victory, right? Mission accomplished, like George Bush after the Iraqi war. I'm dating myself. All right.
During
So
it,
yeah,
yeah.
we're close enough.
Yeah, it did. According to futures, continuous contract 3507.
Oh, of course. Well, with futures, of course. Well, uh, then I'm a genius then. Exactly. That's right. All right, cool. So so yeah, you had a more nuanced take though. You were talking about uh Newmont and GDX and I feel like we should be looking at these together as a non-confirmation or a divergence. I don't, anyway. That's what I don't where's the divergence? There should be something going on here that's not going on properly. So
Yes. Um,
like
well, I
GDX, GDXJ, Newmont, like silver, SILJ is doing fine. Newmont screws everything up for me this month. How's that?
yes. Well, yes, because if we're looking at the monthly chart, and I hope I have this right, GDX was up, I believe, below 2% on the month. I mean, I was looking at a long-term chart and I couldn't even, I mean, it was a doji candle. It's a failed breakout, by the way, in GDX on the monthly chart, but it was up less than 2% for the month, still up a little bit. But if you look at GDXJ, again, not the strongest candle, but it wasn't a doji. GDXJ, I believe, was up 5% on the month. And that's that's your Newmont right there, right? Because Newmont's a huge percentage of these gold stock indices. So Newmont, the reaction to the earnings, that's why at least in the last week or so, I've been focused more on GDXJ and I'm usually more focused on that because those are the companies I follow, cover, and buy. So that's the little divergence. You have a failed breakout in GDX, but was that entirely because of Newmont? It's possible. If you look at GDXJ, again, big difference there on the monthly close. And in addition to that, silver traded right up to 35, which is stiff monthly resistance, and everything came back.
So,
And you could say the sector, silver hitting 35, that's when we peaked out in a short-term sense, the entire sector.
so of all the indices and markets, what should we be least interested about GDX because it's so heavily weighted in Newmont? Like, should we ignore it now or put more weighting on it? Like, which is the one that I'm worried about? Am I worried about GDX or am I happy about GDXJ? Should these two converge again? Maybe it's a
Probably,
fundamental question.
yeah,
Maybe it's
probably at some point.
what happened with Newmont? I mean, can it happen with other miners? It's basically their expenses are out of control, right?
Yes, I mean, and I'll just preface this by saying I don't follow the senior miners anywhere near as closely as I follow the other ones.
Right,
But yes, some of the costs on some of those mines are just, you look at that and you're like, how the F is that going on? Like this is supposed to
right,
be a blue chip mining company and they have just costs that are completely out of control. And we're in 2024. We're not 2 years ago.
right,
Yes, I
right.
mean, inflation it's still rising, but I mean, this is not 2 years ago. Like it's still, so
And
the
energy costs
costs,
are lower, right? Energy
yes.
costs are lower now.
Now, the one caveat with energy costs is that's I mean the gold oil ratio it's a good big picture indicator, and yes, that's helping miners, but
Right,
it can be different for every mining company because big open pit mines are very oil intensive. It's like 35% of the cost, but
right.
underground mines are not they're much less energy intensive. Then, depending on which country you operate in, sometimes you have contracts with the state oil company, and those are signed like 2 years in
Oh,
advance.
so you're locked
So
in.
it's
I get it.
yeah, so
Yeah.
it's kind of it's like a tricky. I mean you can yeah it's a tricky situation. Like
Right.
it doesn't necessarily apply to every company. I mean, it's all over the place when you're looking at it.
It's not standardized. Right, right. So,
Yes.
so
Yeah.
your energy costs may be the price of doing business in that country. Right.
Yes.
I get
Yes.
it. I get it. All right.
But I think in a short term sense, because of the Newmont snafu or the reaction, yes, it's better to follow GDXJ.
All right. There you go. That's because I put like I'm not a miner person. I'll put money in GDX and Newmont actually. Um, so I was like, that means the whole industry's bad. And then I look at GDXJ after having a conversation with you about it, and I'm like, oh, okay. Well, could it be the big miners are that stupid again? Again, you know? I don't know. All right. So,
Well, yeah, it could be both.
right. I mean, but didn't what's his name? Druckenmiller just bought Newmont like, 6 months ago. I I don't, I hate
Well,
this.
but I mean, it had a hell of a move. That's the other thing. If you're looking at Newmont, I mean, I think
Right.
that from the low, that was up 100% from the February low to the peak a couple weeks ago. I mean, that's for a company of that size. We're not talking about a junior mine. I mean, that's a hell of a move.
It is. It is. You're right. Right. So maybe it's healthy. So what I mean is not healthy, but I mean like it's forgetting the news and ignoring the story and just looking at the chart. Maybe the Newmont chart's a healthy give back. I mean, it gave back like 2 months of gains in one day or something like that.
Yes.
So maybe it's not that bad. I mean,
Well, I mean, it's bad because of the impact on the gold stock indexes. But then again, yeah, it's not in the GDXJ, and so that's why, in a short term sense, better to follow GDXJ now.
there you go. I like that. Yeah. So it's a rotation into the juniors. I mean, look, let's look at it on the map. It's a rotation out of the majors into the GDXJ style juniors. So, all
which
right,
are
so
yeah,
let's
which as Bob Hoy coined many years ago, GDXJ, they're the senior juniors.
senior juniors. Right, right. I'm plugging into this now. I get it. All right. Um, what about I mean, silver looked better than gold on the month, right? Or did it? I can't tell.
I mean, it did for a while, but then when it had that test of 35, I mean, that was hit hard. I mean, silver did. I'm looking at it. So silver was up 4.3% on the month.
Right.
Gold was up 3.4%, but gold kept the majority of its gains, while silver did not because it had that pop to 35, which it gave back.
Right. And it gave that back on the chart, and it coincided with like if you pull up a daily chart for silver, you see those big day up is followed by a big day down, and then a couple of days later, big day up followed by a big day down. You're like, that's the nature of silver right now, and it's not necessarily explained by technicals. It's explained by everyone is selling silver to buy gold because of the election, and this could be a major dislocation for us, meaning I'm tempted to buy silver and sell gold, but I know that it could be distorted for another month before it rectifies. Silver will catch up, but these things take longer and longer to fix when you have an event like this. Let me point this out. I mean, a chart doesn't care about what I'm saying. I understand that. But the behavior of these markets is everyone is buying gold because of the election. This is what's going on right now. It's buy the gold because of the election. And we're all already long stocks. So let's hedge part of our gold risk. Let's hedge it by, you know, selling an economic metal. And that would be copper, right? But now it's like, well, now I'm long gold too. So let's sell something that's got a little bit of both. And so they're selling silver. Everyone is selling silver. And it's almost like I want to buy silver if I think the election is going to be a problem, not gold. Anyway, that's it. I mean, I don't want
Because
to.
you're buying the weakness.
Yeah, I'm buying the worst house on the block. I'm buying the beta. Yeah, I'm buying the beta now. Yeah.
One thing on the election. Yeah, I mean, well, 2 points, but like presuming there's not much of an issue after next
Right.
week, like let's say it's just pretty much sorted out.
Uh,
I mean, could we be setting up for you get a hard sell off and then you just get a bounce because all these people were taking profits and they were selling into the election, and then you kind of get maybe so you get like a bullish hammer at the end of the week, and you're talking about the weekly close.
yeah. Let's pursue that because I've been gaming that out for like months now, and it kind of goes like this. My assumptions, right? This is not prediction. These are my assumptions. My working assumptions are whatever happens, gold will be sold by two or three cohorts. One will be central bankers, like at the BIS, and I say that they keep a lid on it, and that's not a manipulation comment. It's like they're just keeping the market stable. Two will be the macro discretionary funds that have been long since March, right? And three will be the little CTAs and smaller hedge funds that are kind of momentum oriented. So when people say, well, when you say that, was the market going to go higher or lower? I'll say, well, I don't know when they're going to act, but I know they're going to act. And here's what I mean. I'll pick macro discretionary, right? The bigger hedge funds, the bigger global hedge funds that have been long since March, they have been selling for the last 2 months. They have. During sell season, they sold. They didn't sell everything, but they've been selling for the last 2 months, selling it to smaller, lesser capitalized players that are punting for the election. And so they're booking 6-month profits, handing their positions to uh, shorter term horizon, shorter time frame election speculators. And they have more to sell, the macro discretionary guys. So it's kind of like, I just made $300 on gold. I'm going to sell 1/3 of my position. I have 2/3 left to sell. Where am I going to sell it? Well, I think we're going higher after the election. I'll sell it $100 higher, or I'll sell it if the news is bearish. And so I'm looking at it like a game of chicken now. I believe that the Bank of International Settlements, which is, that's the bullion bank's rich uncle. Let's put it that way. The bullion bank's rich uncle will keep an orderly market in a rally, but they will let it rally before they sell. Whereas the macro discretionary guys are just going to sell out of the gate. So I'm wondering who's going to buy it. If the news isn't absolutely like, we don't know who the president is, aliens have landed, and
It's 269 to 269.
yeah, exactly. Like unless it's a real disaster, I don't know who's going to buy it. And I know that this is the most watched election of all time, right? And gold is the most watched market it's been in 30 years, right? And given those two things together, I know the police officers on these markets are watching them. And they're not going to prevent it. They're not going to prevent it from going up. But as soon as people are done buying, they're going to get it back down. Like, if you look at the 2016 when Trump won, it was like $80 lower in Asian hours. But they don't
Yeah,
care
it had
about
the
Asian
little
hours.
pop and then it went.
Yeah. I mean, on the day, futures finished like up a couple bucks. But that chart for that, I have that chart. I'll give it to you. That chart that day was $80 higher as the election totals came in when Trump won. And then by the time we came back to New York time, it was essentially unchanged. So if you're an American waking up at 9 o'clock and you don't care about the overnight markets and you're not obsessed with things like we are, you're like, oh, nothing happened in gold. I don't care. Move on. You get to say, and gold was unchanged if you're in the mainstream media. Meanwhile, it was capped. So I think that happens again here. What makes it not capped is if it's 269 and 269, like you said. And then it's like, we don't know. I mean, there's a significant, I mean, just looking at it statistically, there's a significant chance we're not going to know who the president is for a day, a week, months, because with finality, because unless it's a blowout by Trump or Harris, obviously it looks like Trump more than Harris now. Unless it's a blowout, it'll be contested. I mean, this is not me talking. These are political and equity analysts that are saying, look, if Trump wins by a little bit, then Harris is going to file something to protest on a constitutional basis. I'm making it up, but I'm not. This is what they say. Say, you know what? He's a felon. Let's see if that's still okay. And if Trump loses by a little bit, if Harris wins by a little bit, then he's going to go state by state looking for recounts, because of the ballot issues. I mean, look, he was right about Bucks County, Pennsylvania. He was right. Like, that's crazy. Like, it's crazy. And, it probably happens all over the place, all the time, everywhere, but he's calling them out on it. And so unless it's, just to bring it back to the point, unless it's an unmitigated blowout, there's going to be problems. The question is, how big of a problem does it have to be to get gold higher? And that's what I don't know. And so that's why, being completely frank, I'm flat. I'm not speculating on this market right now at all. I will have a position going into it. I might be long. I might be short. I'll probably have a straddle on, because I think we will have a $50 or $100 rally followed by a $50 or $100 sell-off. If we have that $50 or $100 high rally and it's because it's 269 and 269, then we probably won't have that $50 or $100 sell-off. First move, like, my reaction is, on election night, the first move is higher, the second move is lower. The second move could come that night or it could come 2 weeks later. That's it. So that makes me kind of screwed up on my chart analysis.
Yeah.
And I feel like next week I just want to, like, black it out. Anyway, I'm babbling. You get the point. You get the idea.
Yeah, I mean, my contrarian thinking is a contrarian scenario. Like, let's say, a couple more days, we sell off into the election, but then at the end of the week, it's like, there's no problem. We know who won. We know what Congress is going to be. And then you have a gold rally just because of the way the market was
Yeah,
positioned. Or,
you
I mean,
mentioned that.
gold rallies, and then they'll say, oh, we're hearing so and so won, and they're going to planning to spend tons of money. That's why gold rally, they're already writing the stories in
Yeah,
advance, basically.
that's the scenario. I mean, that's a scenario you were talking about with the hammer, with the
Yeah.
hanging man or whatever you want to
Just
call it.
think, yeah, just being a contrarian. I mean,
No, no, all right.
and contrarians are wrong most of the time. That's what people have to remember.
right, exactly. Right. So to play with the angle that you're talking about, wouldn't it be cool if everybody's thinking like me, like Vince in this situation? And wouldn't it be cool if everyone's selling it now because they're worried about this stuff that Vince is talking about? And wouldn't it be cool if we dove as the election approached and then the election happened and then we rallied? Yes, it would be damn cool. And I, as a person who likes to look at it first way, second way. If whatever way we go the first way, we're going to go the other way the second way. Like I feel like it's going to be an unchanged
Yeah.
day. But now coming right to that point, if everyone pukes going into the election, if I mean everyone, if everyone pukes going into the election, we will go up after the election. But unless everyone pukes going into the election, we won't. I think there's going. I want to agree with you. The chart is going to tell the tale. Forget my flow analysis and fundamentals. It's like, is there a hammer? Well, then buy it. You know, is it an hourly hammer? Then buy it with a 3 hour window. Is it a daily hammer? Then buy it with a 3 day window. Is it a weekly hammer? Then buy it with a 3 month window. Well, I need a hammer to get long. On some time frame. My point is, if gold drops $50 between now and the election, let's say it's the day before the election and gold is $50 lower, which is not much, right? I don't care about the dollar move. I care about the open interest. I want the open interest to drop 100,000 contracts. Then I could say the idiots are out. I feel like we should be charting the open interest now, not the price. You know what I mean?
Yeah.
The open interest, like gold could drop $300 from these people getting out. I need to
Well,
see that they're out.
has open interest started to come down yet, or no?
Well, that's the thing, open interest, uh, open interest started to come down in September. Remember, that's my famous sell season. Open interest started to come down in September, and then boom, we exploded higher. And what I saw was the bank started saying buy gold to normal Westerners, and they started buying gold, and they're buying it as the big macro discretionary guys are booking their $500 profits. The ETF buyers are pushing it up, and they're pushing it up.
So that's
And
why
so what happened?
sorry to interrupt. That's why the banks are saying buy it. So they're helping the big swinging dicks, as I like to say. They're giving those guys, I don't know what the word is, the
Exit
ability,
strategy.
yeah, exit
Exit
strategy. They're
strategy.
helping their bigger clients exit while their smaller clients come in and
Right.
buy after. You got to love the way these guys do. Oh, now they're bullish on this is what happened. I mean, you know this. You've been doing this
Yeah.
much longer than me. Gold, it's like, what was that bank like last year or earlier this year when gold broke out and they had the target of like 2,200 or like
Yeah. Yeah.
2,300.
I
I
don't know,
mean,
but I know what you're talking about. Yeah. Yeah.
it's
Yeah.
like, so it's like we've broken out of a 13-year pattern, and you're calling for gold to go up like 100 or $200. Like, and now that gold's gone up, $600. What is that? Almost, it's like 30% on the year. Huge move.
Right.
Now all the banks are like, yeah, we're bullish now. You got to buy. It's going to 3,000. It's going above 3,000.
Right. Well, I mean, I've written several stories on this phenomena, but you're pretty much nailing it. And that is without accusing them of making an exit strategy for their clients, even though they are. But I just want to be objective for a moment because I can sling shit with the best of them. But the 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 bank's biggest clients started buying gold in December of last year. And then the bank's biggest clients started buying gold more obviously in March of this year. That's when gold started to ramp up. And when that happened, the banks were responding to their clients. They were like, all right, we better get long too, because our smartest money is getting long. But they couldn't recommend gold to their regular clients because, hey, rates were high. Hey, the dollar is strong. And all of their reasons for buying gold for the last 30 years, we think the dollar is going to be weak, buy gold. We think rates are going to drop, buy gold. They were treating gold like it was a tech stock, Buy gold if you think there's going to be lower rates. Buy gold if you think the dollar is going to weaken. But now you have the dollar strong, you have yields are high, and gold just continues to ramp up. So for their biggest clients, they were like, we see what you're doing. For their regular clients, they're like, we can't really tell you to buy gold right now. And so you started hearing the bullshit. The bullshit was, well, 2,200, it's trading 2,300 now, but we think that interest rates are going to kick in any day now. We think the strong dollar, which remains strong, is going to kick in any day now. And so they never raised their targets. They kind of stuck their head in the sand, and gold just went 2000, 21, 22, 23, 24, 25. And all the macro discretionary guys are buying and buying and buying it. And the regular clients are like, but the regular clients aren't upset now, mind you, because they're all freaking long Nvidia. They're like, I don't care. I don't care about gold making a new all-time high. Nvidia makes a new all-time high every 5 minutes, or whatever, the Nasdaq or the Dow or the S&P. And so the clients aren't unhappy, and the banks are trying to figure out, this is my opinion, but I'm right. The banks are trying to figure out how to package gold to their regular clients without contradicting their internal culture, which is like dollar yield, right? Okay, so to bring this home to the whole 2,200, last time we talked about this, 3 months ago, the biggest, most powerful banks in the bullion bank area started putting out new reports. And those reports changed. They said, some of them pretty much announced it. They said, we're changing how we model gold. We're announcing a new way to model gold. And they were very good. But it's like stuff that stuff that I knew last year, but most people in the world don't know. Like, let's face it, we really do know more than most people about this, not because we're geniuses, but because we've taken our heads out of that mainstream media culture in time before our brains went to complete mush. But anyway, so the banks are going, all right, here's why gold's going up. We're going to share it with you now. That's because all their clients are already long. This is where they're kind of honoring both gods. They're between a rock and a hard place. So now they're like, all right, here's why gold's going to go up. Here's why gold went up. It went up because China's buying. You're like, oh, and all the Americans like, oh, China was buying. That's why it's going up. But isn't China evil? Yeah, but they're making gold go up. Don't you want to make money? Okay, so now they've got everyone understanding that gold's going up because people are buying gold, but they're not going to say sell bonds. See, they can't do that because that's like culturally, that's a neo-Keynesian thing. And so the next phase of the bank's analysis, which it's excellent, and they're right, is that, all right, so now that China has bought and gold has gone up, it's done, right? And now the bullion banks are like, no, it's going to keep going up because the Fed's going to start easing. And the Fed started easing, and it kept going up. And so now the bullion banks are making money for their normie ETF buyers. Their bigger clients are selling, taking profits. And this is a technical thing. I'm describing the fundamentals of a technical concept. And that concept is strong hands are selling to weak hands. Strong hands are selling to weak hands. How much higher can this go? A shit ton higher, because this is a wave that might really be underestimated. The problem is strong hands are selling to weak hands. So if the Fed, for example, if the Fed were to turn around and say, we're not going to cut, or we're going to raise to make it a disaster, this time gold drops because they're paying attention to the dollar again. So while I want to say to you and everyone, the next $100 in gold will be higher, I fear the next $200 in gold can be lower. And so I'm looking at wider ranges and I'm agnostic right now. And but I'll tell you this, 4 years from now, gold will be higher. Let's not forget the fundamentals. Like you're just saying, the story will be the deficit. Yeah, that's right. It's not going away. That's not done. We're going to continue spending money, and gold's going to keep going up, and bonds are going to keep dropping as people rotate out of gold into bonds. And eventually, and I'm segueing for you here, and eventually your 60/40 portfolio will get crushed by gold. And that's what we're hoping for, right?
And then I can wear my gold suit for our audience.
That's right. That's right. Will you wear a gold tie with a gold suit?
Yeah. Or I could, I think I have some gold teeth, but I'm trying to, I might, yeah, we'll have to do the whole thing.
We'll save it for the rap record. We'll save it for the rap record. Yeah, exactly.
Yeah, just before we get into the 60/40, I guess just like a 20 or 30-second answer from you. Did we get a CPI a couple days ago? Or what inflation report was that?
PCE came out, and it
PCE,
came out.
okay.
It
A
came
little
out
hot, right?
a little hot, right? Came
So
out a
do you
little
think
hot.
do you
Yeah.
think part of the sell-off now could be because the market is discounting the Fed will not high or cut next
Well,
meeting?
the market is moving away from now. Let's ignore stocks for the moment, right? But if you look at the market's handicapping of the Fed, they have like these short-term interest rate futures, STIRs they're called. A month ago, we were discounting the Fed cutting another 50 basis points in November. Okay. And now we're discounting them cutting less than 25 basis points. So the market is slowly moving towards a potential for the Fed to not cut. Now, is that possible? Until today, I would have said to you, there's a 25% chance the Fed won't cut at all. But today's data, which was uh, unemployment, came in abysmally low. Payrolls, the jobs that were added, 100,000 jobs are supposed to be added. And of those 100,000 jobs that were supposed to be added, only I think 17,000 were added.
Oh,
And
oof.
but here's what's worse about it. This is why they're going to cut. Here's what's worse about it. Of the 17,000 that were added, private business dropped. I don't have the number, but private business dropped something like 40,000, and the government hired 60,000, something like that. So of all the jobs, they were all government, all of them.
Oh, well, but could we now see government jobs in the coming months like really start to decrease? Because if 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 uh if whoever I said it, I think a couple months ago, whoever wins, I mean, politically, you want a recession like early on
Right,
rather than later on. So,
right.
I mean, is that also a risk that you could see just the government jobs start to slow down?
Oh yeah, I see what you're saying. Statistically speaking, you would look at that and you'd say, well, at some point they'll stop hiring and we'll have our recession. I agree. But I'm looking a little bit less statistically, and I'm looking at more like a conditional probability where the government is expanding to cushion the economy dropping down.
Oh,
Now
so
that
they're
sounds
already, yeah, they're already doing that, and they're not going to slow it down.
they're not going to stop. I mean, they're not going to stop it. I mean, and I'm saying this, I'm pretending that I'm the president and I have a brain, right? And I'm saying this, the economy is going to slow down. We're in the process of transitioning to a more manufacturing economy, but it will take time. So we have to spend money, build back better, all that other stuff, right? But in the meantime, we want to give people jobs. We want to keep unemployment low because we want to get reelected. I mean, it really is that simple. So the question now, to answer your question more directly, after the election, oh yeah, unemployment's going to go up. Oh yeah, because, and I'll put a fine point on it for you. If Trump wins without GOP sweep, this is consensus. I'm not a political analyst, but this is consensus from people who I respect. If Trump wins but the GOP doesn't win the Congress, then that's a split government. A split government means we won't spend more. We'll keep spending as we are. But it will also mean Trump will probably stop hiring people, right? Harris were to win with a split Congress, then we'll just do what we're doing. If the thing that makes things materially worse is if Trump wins with a sweep of Congress. So if Trump wins and the GOP wins everything, he's going to stop. Yes, he's going to stop hiring people, right? But he's also going to spend more money on the things that he wants to spend more money on. There's no difference between the Republicans and Democrats in that respect. But to be fair, the scenario is that's being painted is if you have a gridlocked government, spending will remain the same, which is bad enough. If you have a mandate, you'll have more spending. So, I mean, I feel like the deficit's not going to go anywhere, or it's probably going to get worse. But in your comment about the recession, like there's tactical and there's strategic. Strategically, gold has to go up. Bond yields have to keep going down. It has to happen because of what's baked in the cake. Tactically, I feel like whoever the president is on his first day, he's going to be like, unemployment's higher. Let's blame it on the last guy. Like that's right. If Trump wins, you blame it on the last guy.
That's what I said a couple months ago. Yeah.
Right. And wait, but here's the best part. Would you say this a couple months ago? If Harris wins, she blames it on the last guy. She doesn't want to be attached to Biden at all. She has to be, but she can't be. It's like, I'm with Biden. Everything that Biden did, I approve of when she's talking to her voters, when she's talking to undecided, or male independents. She's like, I don't necessarily agree with Joe Biden. So, it's
all the stuff that you like, I was with him on that. Did you see there was like some funny political ad where there was like, it was like the guy was like mocking and he was like, I forget the words, but it was so, there was one part where he's like, I'm going to stand here at a construction site and point like I know what I'm talking about.
I did see that.
That was like the standing and pointing, like that was hilarious because you literally see that in every fucking political ad where they're standing at some work site and they're pointing.
That's where that's the political ad you're talking about where the guy says he changes his name to like, right. And he goes, and here I am pretending that it's actually very good. It's very good. It's a shame because the Democrats are, and I'm not speaking about party alignment. The Democrats are as bad now, worse, literally worse, as the Republicans were back when Bush was doing the whole moral majority, Christian right thing. And I say that not being disrespectful of religion. I say that being like, they're just using the Christianity thing to get elected, and they're as, dumb as doorknobs. Now you've got on the left, you've got third generation feminists who are like, I'm pro women. Well, what does that mean? I don't know, but I'm told I'm supposed to be pro women. And so you've got like dumb and dumber, in the electorate. So,
but one thing on spending, at some point that's got to kick up again if there's a recession, because you're saying in most scenarios spending will stay the same, but if there is a downturn at some, like that's also, I think you were talking about the tactical and strategic.
Yeah.
I mean, if we do get a real downturn, then at some point spending will have to go up.
You bring up a real problem, and the problem is just go back to your Keynesian finance, not neo-Keynesian, just normal Keynesian finance, which I'm not anti. I don't agree with it, but I'm not anti it. Keynesian finance says that when the economy's good, you pay down your deficits, and when the economy's bad, you juice it to get it going again. We're juicing an economy with spending when the economy's been doing well for 4 years. So, to your implicit point, what are we going to do if it starts doing shitty again? Well, it's like, it's like a heroin addiction that you have to adjust for with, I don't know.
Because the withdrawal is more painful. You can't
exactly.
cold turkey.
But here's the thing. I'm going to give you like a macroeconomic analysis here, because this is a big deal. People like myself look at it and go, we can't spend anymore. We can't spend anymore. If there's a crash, let's call it a crash. If there's an economic crash, right? Let's say China screws up, or they don't stimulate properly, and it comes over here, and our economy crashes. Well, what are we going to do? Spend more fiscally? No, we're not. We're done with that. Here's what we're going to do. We're going to take rates from 5% to 2% in a day. Think about it. What Powell has done is, I mean, let's pretend that we're giving him credit here for a minute. One thing that he has done, whether you agree or not with it, with the inflation, all the problems that he made, he's got a gun full of bullets now, full of bullets. And if there's a major problem, he can press a button and drop rates 2 percentage points. And he probably will, because the fiscal side can't spend shit. We can't spend shit. And in fact, I think that's what's going to happen, which brings us back to gold and silver. And that is, if you want to be bullish gold, I want the deepest recession possible where no one gets hurt. Okay? I want the war with no blood. I want the deepest recession possible, because Powell will hit a button, drop interest rates 2 percentage points in a day, and that will be the end of everything. And all the markets will just inflate higher. We'll do what everyone else is doing, and that's it. So I don't want a mild recession. I want a deep recession, and I want the only thing to go down to be stocks. I'm long stocks. So the Fed will be panicky. Oh, stocks are down. We have to lower rates. So yeah, I think if we have a recession, the worse it is, the better it is for gold. It's kind of crazy, but that's what I think.
No,
The
yeah,
worse it is,
exactly.
the better it is.
It's a good segue, which you tried to do earlier, but then we went off topic a little bit to the 60/40 portfolio and where we are
Yeah,
here and now.
yeah.
Would you like to discuss that?
Well, I'd like you to discuss that.
Okay.
60/40 portfolio. You were showing me a chart, and you know,
Yeah, I will put that up for our viewers. And yeah, so technically, Professor, if you look at the bottom there, gold against the
yeah,
60/40 portfolio, um,
it's
because
never going to break down.
I zoomed in
Yeah,
on Twitter, I posted a second zoomed in chart. By a cunt hair, I'm sorry, ladies, for my language, it it actually broke out by a
did it
hair.
really?
Yeah, so it made a 3-year high. However, that's not really enough of a breakout. Like if you look at what happened in 2002 and 1972, I mean, this thing was really pushing higher. So until we get a real strong move, Professor, we can't call it a breakout. I mean, we did have a
But
breakout, but we could say it's not confirmed, not even
but
close to being confirmed yet.
is this chart monthly? All right,
Yes, it's
let me be
monthly.
like a technician here and ask you some questions. Is this chart a monthly chart?
Yes.
Then shouldn't we, as technicians, I'm asking, I'm not like trying to make a point. Shouldn't we be looking at this saying it's a breakout? You buy it, and you hold on to it for a month, because it's a monthly chart. And if we go below it at the end of the month, you're out. I mean, shouldn't I assume this is a breakout?
Yes, but I'm saying it's only by a hair.
Right,
It's
right,
not strong enough to where we know that there will be follow through and continuation.
right. Okay, so as a trader, this is what I would say then. If I have 3 units of something I want to do, I'll do 1/3 of it. Right? I'll do 1/3 of it. What is that 1/3? Maybe it's shorting stocks. Maybe it's, I feel like, looking at this and listening to what you're saying, I feel like I don't want to buy gold. I mean, only because, not because I don't think gold's going to go higher, but I think the better trade is to sell stocks. And, God forbid, I'm not telling anyone to do that. But if you look at the fact that bond yields are higher and stocks continue to levitate, I want to sell stocks. And if the 60/40 portfolio keeps breaking out because of bonds, which is what's happening, right? Gold strong and bonds are getting
Yes.
crushed. Right. It's the GLD TLT chart that's going parabolic. Um, as soon as stocks crater a little bit, then this thing is going to take off. So really, if you want to be fully committed to this, you should just be shorting stocks. I'm just looking at this saying I want to be short stocks looking at this chart. You follow?
Yes.
I mean, I don't know if I'm right, but
Yeah, I
when you
mean,
pointed
we yeah, go ahead.
when you pointed this chart out to me a while ago, like almost a year ago, I was like, we've broken out against this, we've broken out against that. I almost feel like the Fed looks at this chart. They're like, we don't care if gold goes up so long as it doesn't destroy the 60/40 portfolio. And it's like bonds started to crap out. And I looked at your chart. I'm like, we don't care if bonds go to zero as long as stocks keep pace with it. It's like this chart is like going to be a hyperinflationary chart. The 60/40 portfolio will never get above your red line, but that's because stocks will be at infinity, bonds will be at zero, and gold will be at infinity. Like I feel like
Yeah.
we're going on a hyperinflationary path. I mean, we're not, but you get my point. It's a good
They
chart.
got it. They got to whack it.
They got to whack what
Got to
though?
come in and whack gold.
They do. They do. Look, let's pretend that I'm a banker. Let's pretend that I'm working at the BIS. And I don't want to demonize them, although I do. Um, if my job is to keep a lid on the market, to keep the gold market orderly, and I say that not conspiratorially, the market rallies, you have to provide liquidity for it. Otherwise, you lose your brand, you lose your franchise. And what I want to do is I want to sell it, but I want to sell it after everyone's bought. And I know traders that do that. I know traders that would say, all right, I'm bearish. I'm going to sell it. How many contracts are being bought? 1,000 contracts? All right, I'll sell the last 100 of the 1,000 if you know how many contracts are being bought. So I feel like the bullion banks are waiting to pounce. The question is, will they pounce from 200 higher to get it to unchanged? Or will they pounce at unchanged to get it 200 lower? So I think they don't have to pounce if the election isn't a blowout. I mean, sorry, if the election's a blowout, they don't have to pounce. It'll just go lower because it'll be like, oh, it's a blowout. We know who won. There's not going to be any contention. Sold gold. And if it's a tie, they'll be selling it from $200 higher. I just feel like there's a lot of selling that has to come into the market. I could be wrong. I could be wrong. I'm long, you know. Anyway, so
Yeah,
that's a
no, I yeah,
60/40 portfolio.
yeah, I know. I tend to agree with you. I think that it's more likely than not that we will get at least it's going to take at least a couple months for this to confirm. I could be wrong, but that's just my
Right.
sense. I'd be really surprised if we saw like next month, like gold's up another
But
2 or 3% and stocks are down like 2%. I'd be
yeah, I mean,
surprised.
to bring it back to what you said, because I think it's actually kind of important. It's contrarian, but it's kind of important. What would I do if gold dropped $200 tomorrow? I'd probably be happy because that would be this money getting out because they don't want to worry about. And then I'd say, okay, maybe the cleanup is done and we can start moving again. So I actually, if I had my druthers, just be like an old man, I would want the market to drop $200 tomorrow so I can see what happens going into the election. If the market rallies after the election, I'll be long, but I'll be stupid like everyone else and be afraid to sell it and not make money. So yeah, I think the contrarian idea that you have is a good one.
Okay, are we going to get into the next chart?
The next chart is what? Oh, CPI.
Infl
Yeah, I had a
yeah,
question about that chart, and you answered it. So I want you to answer for everyone else too, because well, I frankly I wasn't that familiar with it. Gold versus CPI, is that the one you're talking about?
yes, sir.
Yeah. Look, there's another place out there. I don't even know the name of it, but they show gold versus CPI as a new all-time high will be like 3,000 or 3,200, depends on who you're looking at. And I see that you're closer. So explain for me what that's about again.
Okay, yeah, and I also see those charts, and I think those charts are like intraday or intra-week. So
Okay.
when gold spiked, they are taking the intraday or the highest daily close, and so
Right.
obviously gold went parabolic. Um, I have not looked at that daily data yet to see exactly where it is. So that's one answer.
Right.
Um, the So here we have Barron's Gold Mining Index at the bottom. Why? Well, because it's my contention that the inflation adjusted gold price is the best fundamental indicator for gold stocks. And you can see the trading patterns over time are very similar. Like gold stocks have been a bit weaker in recent years than where they should be, but a lot of that is because of valuations and also because there's still a lot of money in the stock market.
Right.
So that explains the discrepancy in the last 5 years or so. That aside, okay, so the top chart, that is gold divided by the CPI. So gold divided by the CPI data. Now the middle one, that's data from macro trends. I don't know how they calculate it. I mean, it's pretty similar, but it is stronger than the chart on the top. So
It's not a
the
log normal thing, is it? It's just different.
yeah, it's just different. But so I'm looking at monthly data. That's what you see in these charts. So the macro trends data, gold closed within $3 or $4 of an all-time monthly high in inflation
Okay.
adjusted terms. So we made
Okay.
the second highest monthly close ever. Now, the top chart, gold divided by the CPI data. Unfortunately, that is not updated. You can see it says August 30th there.
Right.
If you update that, it comes out to right now, I think I said 8.73, and you can see the all-time high is 8.91. So that's actually
Right.
the third highest monthly close. So that is, 2%. We're within 2% or so of an all-time high, whereas
Right.
the macro trends data is within a little more than 1% of a new all-time high. So the inflation-adjusted gold price, the bottom line is it's closing in on a new all-time high in monthly terms. It's getting very close.
Right.
And that's a 45-year base, Professor.
45 years. Let me look at, yeah, let me zoom out a little bit so I can see the dates again. Wow.
Yes,
Yeah.
45
Can you
years
imagine
ago.
if the media, can you imagine if the media, I'm sorry to interrupt, but can you imagine if the media ever ran a story that said, not only has gold made new all-time highs 40 times this year, but it just eclipsed its inflation-adjusted all-time high back in the 80s. Like the Fed would shit themselves if they did that. They, they can't write that story. Anyway,
Yeah, you would never see that. You never see that story.
they would shit themselves. All right. So,
So technically, that to me are the two things that stand out. You have gold against the 60/40 is on the cusp of breaking
right,
that key level. And at the
right,
same time, we have the inflation adjusted gold price again getting really, really close to breaking out of a 45-year base. So technically, I think those are at least the things I'll be watching as we get finish this year out.
right.
And then I guess, on top of that, I could say the third thing would be silver and $35 because 35 is really stiff monthly resistance in silver. So,
It is.
and we also mentioned 32, Professor.
That's right.
32 is huge quarterly resistance and yearly resistance. So gold, December 31st, it's got to close above 32 to be a new
Wait,
all-time
you mean
high.
silver? You mean silver?
So, yeah, I'm sorry, silver. Yes.
Yeah.
It's just
Silver's
so
got to
many
close above
numbers in it.
32. Right. No, that's good because that's one of the reasons we started doing these, because at the end of every month we were calibrating if macro discretionary would buy. Like at the end of November of last year, which was our first month, I think, doing this, um, we're like, okay, they're going to buy coming into December, and on December 3rd, they bought the crap out of it. So that was like, oh, let's do this every month. But anyway, the point is, at the end of every month, when you have a new high or a new close, you attract new money. Now, all the macro discretionary guys are already looking at silver. They're all in gold. And so if silver gets this 32 high, that's a new yearly high. Is that what you're saying?
Yes. And it's
That's
it's an important quarterly level as well.
right,
Which
right. So
I mean, I think we did the end of September. Yeah, we did close. I can pull that up, but I think we did close above that.
yeah. So you're going to have, like, it's almost like we'll be deja vuing. Our conversation last year was, this November close. This is what the conversation was like. We were in the middle of buy season. But this is a really good close. This is going to attract money next month. And you're like, yeah, I mean, this is and then you start going with your numbers. It was like 2009. If the market closes above 2009, this is how it went down. Market closed above 2009 on a monthly close, then we're going to be above a certain level, and that's going to be. Remember, 2000 was the number, and it was like 2000. You're like, no, it's
Yeah.
2009. It needs to, like,
Yeah.
kind of get a little bit higher and clear 2000, and it did. And we were like, you know what? Next month, you're like, technically, it looks great, and I was like, yeah. And macro discretionary is looking at this, going, shit, that's a gold new annual high, new monthly high, new quarterly high. Not new quarterly, but and then December came in and the same thing happened and it was off to the races, which brings us to silver. This could be, if this thing that you're talking about happens, it could be silver's turn to do this.
Yeah,
Anyway,
I looked. I misspoke a bit earlier. Last month, the end of the quarter, silver closed at 31, so it has not taken out 32 yet on a quarterly basis.
good,
So
good.
that's yeah, December. That's the level. December 31st, $32 quarterly and yearly. That's my view. Like if we see a convincing close, I mean, even if it's 33 or 34, then I think silver can rally to 50 next year.
Right. I don't care about 35. I mean, just to play this out, big money wants it to go above 35, but bigger money and more patient money wants it to close the year, right? Over whatever the price is, 32, 32 and a
32.
half, whatever it is. Yeah, that's it.
Yeah, and your
30.
point is that macro discretionary traders, the big swinging dick money, they
Mhm.
watch that shit, and
Yeah,
as they did with gold. And if silver makes that close above 32, December 31st, that
that's
means
right.
there will be buying coming in.
We definitely called that last year. I remember that conversation. Because I was like, I was saying to you, I was very focused at that time. And I'm like, what is 2000? And you're like, 2000 doesn't mean anything. It's 2009, roughly. 2009, spot 20, I think you said to me. I'm like, all right. So we closed above it. I'm like, that's it, right? We've cleared 2000. You're like, you gave me the technical go ahead. And I'm like, well, then the macro discretionary is going to buy the shit out of this. So fingers crossed, we want that to happen for silver by the end of this year. I'd rather have the market close above 30. I'd rather have the market close above 32 on the way to 35 than above 32 after coming off of 35 at the end of the year. I want macro discretionary to see a clear trend with an annual, quarterly, weekly, daily close that eclipses everything else. That'll be great. $50 will be a pit stop.
So last thing, do you want to talk about gold and GVZ, the gold volatility?
Yeah,
We have
I
the
think it's
chart
an
for that.
interesting chart. I sent you that chart. You'll share it with people, and I'm going to talk about it for a second. The gold chart, it's a weekly chart, and the gold chart is a candle, and gold volatility (GVZ) is the yellow line, and uh, gold volatility doesn't have to be above. What you'll see if you're looking at the chart is you'll see that gold volatility is naturally more volatile than the market itself. But you'll see peaks in gold volatility that are higher than we've currently had. And so I'll give you an example. In March, that's the highest peak on the chart. In March, when gold started to rally, March 1st, it just started to take off. Gold volatility rallied more. And that's because macro discretionary bought calls. Okay. They bought futures. Macro discretionary likes calls. They bought futures and they bought calls. And then when the market went sideways, mostly sideways through September. I'm sorry. This is March of 23, right? So
Or
March of
March,
20.
you're talking
I'm
about
sorry.
23 or 24.
Let me start over. Let me start over. All right.
Okay.
Let me start over. All right. So I have to start this over because I'm screwing up with the war. The war. The Ukraine war started in February of 22. All right. And that market drove volatility up very high, right? And it didn't really do much. But then in March of 23, gold rallied and volatility went very high. And then you see another peak in October, which is when we talked about this. And then you see another peak in the end of the year in November. That's when gold did its thing in December. And then the next year starts. Now we're in 24. And in March of 24, you see a peak. March of 24 shows a peak in the gold volatility running with the market, running with the market. So gold starts rallying in March and gold vol starts rallying with it. And that's confirmation that macro discretionary is buying. And that's a good thing. Since then, gold volatility has underperformed relative to the market itself, which is a sign of an orderly market, and it's not frothy. It really isn't. what I'm looking at is I'm looking at the volatility as a chartist, and I'm saying, well, volatility is low. It's relatively low compared to the market. If I were bullish gold, I would buy call spreads now. Period. If I were bullish gold, I would buy call spreads now. If I were bearish gold, I would sell calls hedged. That's a different conversation. I guess what I'm saying is whatever happens on election night, volatility is too cheap. Now you can take the opinion that volatility is cheap, therefore they're not committing to the market, and that's bullshit. You can't do that. Volatility is cheap because no one's buying it, and no one's buying it because there's no liquidity out there. I think the volatility has a lot higher to go, regardless of which way the market goes. Anyway, all I'm saying is if you're playing bullish, the volatility in this market is not overbought. Maybe you and I look at the market and say maybe it's a little toppy, but the volatility is not. The volatility is saying we still have room to go. That's it. That's why I'm confused. I don't know what to make of everything.
So, with the contrary, again, my contrarian position, would the contrarian outcome be you get some kind of a spike next week, and then that's like a volatility top for a while, then it just, comes back
Well,
down for a while?
I think that's what you're getting at is if gold were to rally next week and options were to spike with it, if you're looking at just purely at options and a chart, you'd be like, I wouldn't get short. I would wait for the market to go sideways. Here's what I mean. If people are going to start buying options going into the election, next week options are probably going to get bid. That's how these things work. And they'll start buying options. And what I'd like to see is, if you want to do the contrarian thing, which I'm all for it, is the market rallying with options rallying with it, and then the whole thing collapsing and options just getting ridiculously cheap. And then it's time to buy everything. That's it. But I don't know. There's a lot of mixing, there's a lot of noise right now. There's a lot of noise. And so I go back to my simple analysis, which is the next $100 could be higher, but the next $200 could be lower. And so I want to watch the tourists screw up, and then I'll step in and pick up the pieces. Hopefully, knock on wood. You follow?
Yeah. So, yeah, great analysis, Professor. It could be higher, it could be lower.
Yeah, exactly. It's like, hey, I'm an analyst. It could be high. No, but that's advice that I used to get from a guy who was really good. Like, I would go up to him and I would say, "What do you think?" Okay. And he would say, "Well, how much do you need?" This is what he'd say to me. "How much do you need the market to move?" And I would say $5. He'd say, "Well, the next $5 will probably be higher. The next $100 will probably be lower." So he was saying that short term, long term. That's the way he was saying it. So I'm saying to you, the next $100 should be higher, and the next $200 could be lower. Now, the next $10, it could be tomorrow. The next $5, the point is, I'm no longer talking to you like the next $20 is higher, the next $40 is lower. I'm saying the next $100, I don't care. Like anything $50 either way is noise right now. That's how interesting the
Right.
market is. Good for trading, but bad for investing. That's really the way to look at it.
Right. Okay, Professor. Anything else we got to cover?
There's one other chart that I want to throw at you because it actually plays into your let's have a crash landing recession. There's a chart. I gave it to you. You could show it. It's called Move, and it's
Move.
the
Okay.
chart is
Bond volatility. Okay.
bond market.
I got that.
The M is for the market option volatility. Bond market option volatility. So it's like the VIX for bonds, and it's not entirely watched yet like the VIX. And the chart that I sent you is a monthly chart, and the Move, the bond market volatility index, for the month of October has its highest close in
10
10 years. Whereas if you look at that chart, you can see that that's the October 31st close there. That chart is
It's pretty
at the
close.
highest close, right? Going
In
back
at least
20,
5 or 6 years, it looks like. Well, because I only see
exactly.
2018 in the chart.
Right.
Yeah,
Now,
it's
I
very
guess
close.
what I'm getting at is when the bond market volatility goes higher like this, and the bond market is trading like a penny stock right now. When the bond market volatility goes higher like that, it's a sign of financing problems. So financial conditions are getting hard somewhere. I don't know where, but someone's got a problem. Maybe it's a bank, maybe it's a big hedge fund, but this is not over yet, is what I'm saying. So we could have the spike in volatility going up to, what's it, 135 there? We could have the spike in volatility go up to 200, and that will be the end of it. But the point is, the bond volatility market and the VIX is telling you now that there is something looming, and I don't know what it is. Gold is just going up now. So I think there is, I'm betting on something that happens that craters everything. That's what I'm betting on. I mean, I don't have a position on yet, but that's what I'm looking at. I'm looking at the volatility of bonds, and I'm saying somebody's stressing out, and I don't know who it is. That's a bond guy to understand. But we could have our crash. Our crash could be coming.
Well,
there's your title.
Just say, hope not. Oh, crash could be.
Right. Hey, everyone. Vince says crash is coming, and then everyone can be like, oh, what a liar. What a bullshitter. Anyway, but that's it. That's it.
Thought the title was the next $100 could be higher or could be lower.
Right. So Vince Lanci, where's the market going? I don't know. I have no idea. Like I would bet that the next $10, the next $20, the next $30 is lower. Period. I'll say that right. I'm betting that the next $30 is lower.
Okay. And then when the election, sorry, go ahead.
And then when the election comes, it's like the next $100 has got to be higher, right? That's it. So silly.
You said the next $200 could be lower. What about the next $350?
Oh, well, obviously higher, right? Okay. I mean, that's my position. But if the next $350 is higher, then I'm just going to be long silver, right?
Yeah.
So silver's going to go to $50 before it gets more than $100 higher. So yeah, I mean, look, I'm saying like we could print $100 higher and settle unchanged. That's what I'm saying. If you're an American trading in American hours only, you may miss your chance to sell it in Asia when Trump wins, but it's a close race. And then in the US time, they knock it back to unchanged. That's my point. That's my point. It's two markets.
Okay, Professor. That wraps up this episode. Before we go, Professor, Gold Fix, tell our listeners and viewers where they can go, how they can subscribe to your outstanding Gold Fix publication.
Thank you so much. The check is in the mail, Jordan. No, the goldfix.com. It's a Substack, so it's goldfix.com. It's probably vblgoldfix.com. It's a newsletter, and I'm a trader of 30 years, and so the content is a mix of trading insights, not technical. It's a mix of bank analysis, and it's a mix of macroeconomic analysis for people that are looking to broaden their scope in trading. The thing that sign up for free and sign up to pay, whatever you want to do. But right now, like for example, last week people were talking about gold as a tier 1 asset and silver as a tier 3 asset. So I did a whole broadcast on what gold is as a tier 1 asset. So we talk about everything under the sun except technicals, which is why I come on here. So yeah, goldfix.com, and be happy to have you.
Okay, Vince, thank you so much for that. That wraps up this episode. Thanks everybody for tuning in, and we'll talk to you guys again a month from now.
Thank you for tuning in to the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.